Hello and welcome to BQ Prime. You're joining us on this special interview where we are talking about the recent credit profile upgrades done by S&P Global Ratings. It is with respect to banks, large banks in India such as State Bank of India, HDFC, and ICICI Bank, as well as some of the other entities in the system. And to discuss this further, we have with us Nikita from S&P Global, the Associate Director. Take a quick question. Firstly, welcome to this conversation. I want to bring up this question about where we are in terms of these credit profile upgrades that you've done. In State Bank of India specifically, I noticed that the last time any action happened was in 2012. So that was like a while back. And then now you've upgraded it. What has changed in 2023?
Thanks, Vishwanath. So, two things have changed in our view. First of all, the operating conditions for banks in India is very supportive. Robust economic conditions are putting forward a very solid backdrop for banks to operate in the country. We have a 6 to 7% GDP growth forecast for India over the next 3 years, which means India is going to be one of the fastest growing major economies in the world. Add to that, the consumer and business confidence levels are also at very good levels. So all these factors are very supporting. Secondly, the financial performance of the individual banks have also substantially improved over the last few years. Asset quality, earnings, capital, all of them are on a solid improving trend. And we see some structural improvements. For example, the time taken for resolution of bad assets, and also the general credit discipline in India, they also seem to have improved. So, which means that these banks are on a stronger footing as compared to where they were, say, 5 years back, in order to absorb stress in future downturns. And that has, those are the two primary drivers for our upgrades or SACP revisions on these banks.
All right. I want to take the viewers through a little bit about what SACP actually is, the standard asset credit, the credit profile of these entities. I want to differentiate that from where credit ratings are, because that's something that people tend to sort of confuse the two. So if you can just tell us what the difference is, essentially.
Sure. So standalone credit profile or SACP is an entity's intrinsic creditworthiness before we take into account any kind of external support, be it parent support, be it government support, be it support as, government owning the bank. So any kind of support, it's the credit profile of the entity before that support. And the final ratings on a lot of our Indian banks are capped by the sovereign rating, which is at a BBB minus with a stable outlook. But you will note that a lot of the standalone credit profiles are now higher than the sovereign. So that's the difference. We will not rate banks higher than the sovereign simply because we don't believe that a bank can withstand an event where the sovereign is in distress.
Understood. So coming to the credit profile, sort of an upgrade, what does this mean for an entity that is going out and borrowing money from domestic and foreign investors? Does this play into the cost of that borrowing?
So at the moment, I would say no, because what happens is typically the senior secured bonds are priced based on where the final ratings land. And for these banks, the final ratings for SBI, HDFC, and ICICI, the final ratings has not changed. The other angle on this is the rating of an additional tier 1 instrument, which is typically notched off from the standalone credit profile, especially for private sector banks in India. But again, there the sovereign ceiling comes in. So say if the standalone credit profile is higher than the sovereign rating, we will notch off from that issuer credit rating rather than the standalone credit profile. So in terms of pricing, probably at this moment, it doesn't change things significantly. But what this means is that the ratings on these banks, the final ratings, will move with the sovereign rating. So if there is any change in, say, the outlook on our sovereign rating, or hypothetically, if the sovereign rating gets upgraded, it means these banks' ratings will move in tandem with the sovereign rating.
Okay, fair enough. I want to also talk to you a little bit about the potential risks in the system, because we are in a sort of a sweet spot as far as the banking industry is concerned. The past NPA problems have been dealt with. Capital positions are pretty strong. You're seeing some amount of credit growth also, at least in the larger banks, it's quite strong. But in terms of the downside risk, what do you foresee is something that one needs to be watchful about?
Yeah, so there are two key risks that we are watching out for. First of all, we do see that the leverage in the system is creeping up. It is still very low compared to regional standards. If we look at the household debt to GDP, for example, in India, is still very low. But unsecured retail loans continue to grow very fast, and they continue to have a higher share in the total loans portfolio of the banks. So that is one area we watch out for. Typically, when economic conditions deteriorate or employment conditions deteriorate, these are the first asset classes that start to show higher delinquencies. No such signs so far. Everything remains stable. We also believe that the risk management of banks has been fairly tight when lending to borrowers on an unsecured loans basis. But this is something that we will continue to watch out for. I think the other thing that we watch out for is dilution of risk management practices. A lot of improvements that have happened in the banking sector over the past few years are also a byproduct of the fact that banks have tightened their risk management practices and underwriting standards. And now, as you said, the banks are in a growth phase. There are a lot of growth opportunities, especially, as I said, on the unsecured retail side. In this time, it will be very important to hold on to those tighter risk management practices. Any dilution there, and few years down the line, we could see another bad loan cycle ensue. And that will only be apparent few years down the line. Whatever loans they give today, the asset quality will only turn out good or bad few years down the line. So we'll have to watch out for those two key risks.
Are there any lead indicators to look at when we're talking about the dilution of risk standards? Anything that shows up and sort of warns you beforehand, before the asset quality numbers actually go?
Right. So here, credit bureau data is very rich based on what is published in India. So CIBIL data. There are a lot of indicators in terms of early delinquency. So not just 90 days past due, but 30 days past due, 60 days past due. They can give you an indication of early level delinquencies in any product. Secondly, I think it also shows what are the approval rates, whether there is a very sharp increase in approval rates, which could potentially indicate that banks could be diluting their risk management standards if the approval rates are very high for loans. The other thing to look at is what is the distribution of customer profile. Is there any increase in lending to, say, subprime customers? Right now, none of these metrics point to any dilution, I must say. All these metrics remain fairly stable when we look at CIBIL data and credit bureau data.
Just 2 days ago, the Reserve Bank of India put out its financial stability report. Now, in that, there was one point that caught my attention, which was on the credit card receivables at public sector banks. And that even though their share of total credit card loans is very small, but it seems that the loan book is quite risky. It's about 18% sort of a default rate, which is, to me, at least alarming, because that's usually the signs of things not going so well. But could it be because these banks have not been in the credit card market for a while, and maybe now they are starting to enter because that's where the business is, and things might be looking better on the private and the smaller sort of small finance bank side, the unsecured quality looking better there versus public sector banks?
Sure. So you're right that within the unsecured retail space, including credit cards, there will be a lot of difference between various banks because it totally depends on individual banks' lending standards. For example, some of the large banks, including SBI and ICICI, we know for a fact that they typically lend unsecured to their own corporate salary customers, which means they have good visibility on the cash flows. They are regularly seeing salary increments, and that is one of their basis for giving out this loan. They feel comfortable that based on this cash flow, they can give out this loan. The other thing is a large part of this lending happens to salaried borrowers. So as long as employment conditions in India are fairly stable, at least in the formal sector, it means that default rates in these products should not be extremely high. Now, I must point out that typically delinquencies, early delinquencies, as well as what you call a non-performing asset, which is 90 days past due, in credit cards will be higher than some of the other products. These are typically higher risk products generally per se. And I think if I look at all the product segments, credit cards is one segment where we have seen some rise in early delinquencies even over the past few quarters. But still, it remains more or less at manageable levels. What happens in credit cards also is that maybe a customer is, has not paid in 30 days, but once the bank follows up and they kind of, explain to the customer, they end up paying after some period of time. So there may be a bit of lag, and it may show up as an early delinquency, but it does not automatically mean that this customer is going to default. This is quite a common practice in credit cards. Just one last point on this. Absolutely, on a risk management basis, we don't believe that every bank is at the same level. I did talk about some of the tighter risk management practices that we see in some of the large banks, but at the same time, some of the we would say mid-sized banks or some of the smaller banks, they are a bit more aggressive in this sector given the opportunities, but not everybody's risk management is at the same level, and that will kind of show up in the individual banks' default rates on this product.
Right. I want to bring up this topic of the resolution of bad loans. That was one of the factors that you mentioned earlier for the improvement in the credit profile of these banks. Having said that, the time taken for this resolution still, it has come down from say 7 or 8 years, but it's still pretty high at about 450, 480 days. If I'm not wrong, that's the approximate time it takes before adjusting even for court delays. It still takes about 400, 450 days before a case is actually resolved. I'm just curious to understand how does this compare to, say, other geographies? Is India still better off in terms of resolution?
So, resolution framework metrics have improved a lot over the last few years since the Insolvency and Bankruptcy Code came in. The code itself stipulates 330-day timeline. So we are still off from the code because in fiscal 2023, the typical time taken for resolution, as you said, was between 1 to 2 years. So it is still long. There are still court delays. So the legal framework is not exactly very tight, but it's much better than what it was prior to 2016. And hence, you've also seen in the last few years, the bad debts that came out of the corporate debt down cycle a few years back, they have gradually seen some resolution, and that has improved the asset quality as well as profitability of the banking sector. Now, how does this compare to some of the other markets? So in terms of developed markets, this is still quite long, and that is why we continue to have a negative adjustment for India in terms of payment culture and rule of law. We generally believe that although the improvement has been quite substantial, legal framework still remains a work in progress in India. And compared to the 1 to 2 years that is being taken right now in some of the other developed markets with stronger scores on this particular metric, the time taken would be far less.
Okay. The last question I want to bring up is on the capital adequacy front, because that's sort of the basis of all growth and protection of the balance sheet. I want to understand from you, currently everybody is significantly above the regulatory minimum. So there's still headroom for them to deploy that capital in a more productive manner. But do you think there is still room for banks to go out and raise more money?
Right. So there are a lot of credit opportunities in the market. So we do expect a 12% credit growth. But at the same time, we are also seeing that the earnings have improved substantially, which means every single year, the bank is kind of putting in more internal capital. And hence, even at that, say, 12% growth at the sector level, the capital ratios are gradually increasing. They are not declining simply because your earnings are at a good level. Dividend payouts are mostly reasonable. There are also regulatory caps on dividend payments, etc. So that has kept internal capital generation pretty good. Now, say if at the sector level itself, the credit growth requirement is extremely higher than what we are projecting. It could be because capex cycle picked up in a material fashion in various other sectors, and hence, banks are clocking say 15-16% kind of a growth. Then maybe you could say that some of the banks would need to raise additional capital in order to keep their capital adequacy ratios at the same level as where they are right now.
Understood. All right. Thank you so much, Nikita, for joining us on this conversation and taking us through all these points. And thank you so much for watching.
Thank you so much for inviting me. Thanks.